and I'm going to ask for our next testifier, who's Toby Heaps, CEO of Corporate Knights, who's by Skype. And so maybe hearing me as I'm looking at him. Some of us are looking at him and passing the microphone over to you, Toby. Thank you for being with us today.
Yeah, thank you. It's an honor to have this opportunity. Just to clarify, can everybody hear me?
Not so clearly.
You're breaking up a little bit.
Maybe it's your mic.
If you speak closer to your microphone, it might help.
Can everybody hear me clearly now?
Yeah.
Yes.
Get a little more close.
Okay, good. Okay. So I'd just like to start by saying it's an honor to have this opportunity. And I've always wanted to visit the Albany State House in person to see the oil paintings of Teddy Roosevelt. But I guess I'll get that opportunity, hopefully. So just a quick word about myself and Corporate Knights. Corporate Knights is an independent Canadian-based media and financial research company. We have a little over a decade quantifying corporate sustainability, including the rankings of the global 100 most sustainable corporations in the world, which do include energy companies as well, and the Newsweek Green Rankings, which we do the research for, and the Sustainable Stock Exchanges report, which analyzes 55 stock exchanges around the world each year on sustainability disclosure. We've also designed and developed a clean capitalist decarbonizer platform to measure and clean portfolios to investor specifications. And we work with the financial industry and with associations in the financial industry to help build awareness about climate risk, including having been a formative part of the formation of the Montreal Carbon Pledge, which is a group of global investors with assets of $10 trillion US who have pledged to report their carbon emissions on an annual basis publicly, and with an aim to reducing those emissions and the risk over time. So I'd like to just, before I get into my comments, briefly address some of the comments from my colleague from the American Petroleum Institute, who had the opportunity to speak before. If I gather correctly, I think she made five main points. The first point was that the studies that say that divesting is good for financial returns are based on cherry-picked numbers, and when you look at other studies, like ones funded by the American Petroleum Institute and others, they find different numbers. And I think if you look at the studies that are done by the American Petroleum Institute or some of the ones that were referenced, a lot of the timeframes were much longer than 10 years, and some of the ones that were 10 years only went to 2013. If we look at today's numbers, as of February 26th, today, the fossil-free index US, which is based off the S&P 500, if you would have had invested $1 in that index 10 years ago, it would be worth $1.73 today. If you would have invested $1 in the S&P normal index, that would be worth $1.63 today. So you'd have an extra 10 cents. So over 10 years, the performance hasn't been that markedly different between fossil-free portfolios and portfolios which contain fossil stocks. Over 20 years or 30 years, you can find timeframes definitely where fossil stocks have outperformed the market in general. But over the last, as of today, the last 1 year, 5 year, and 10 years, there are no time periods where fossil-free stocks over that extended period of time, that 1, 3, 5, and 10 year, there are no periods where fossil fuel stocks have outperformed the market, and that's a fact. We can pick our indexes, the MSCI ACWI, the S&P 500. That is a fact. Now, we can't assume that what has happened in the past will be prologue for the future, but there are some pretty fundamental shifts going on in the economy, and I think it's interesting to recall, if we go back in time to 1890 and we were to look at the Dow Jones Industrial Average and look at the stocks that investors were invested in, 40% of investors' investments were comprised of railway stocks, of train companies and rail companies. And the world's changed quite a bit. We had Henry Ford come along, we had the automotive industry take off, we had a lot of other industries take off. But all that's to say that just because the fossil fuel part of the economy has been a significant part of the economy for most of the 20th century, is no guarantee that it will be a significant part of the economy for the 21st century. In fact, in Paris, as Bill McKibben touched upon in his remark, that I gather, over 195 countries agreed to phase out fossil fuels this century, with developed countries like the US and Canada and European Union leading the way. So to assume that amidst this energy transition, that the past period of 50, 60 years for oil and gas stocks and coal stocks will naturally reoccur is an assumption that takes some leaps of faith that I don't think are sound from a fiduciary perspective. So then the second point that was made by my colleague was that telling State Controller Tom DiNapoli what to do is out of the bounds of jurisdiction of the legislature of the state of New York. And I think there are ample precedents that suggest that is not the case. Let's look at tobacco, let's look at cluster bombs, let's look at South African apartheid divestment. Let's just consider a hypothetical for a moment. If the New York Common Retirement Fund had 7% of its holdings in stocks that were trading in slavery, those stocks were performing well, which is not the case for the oil and gas stocks. Would the state legislature and the state senate, would they have a role in possibly curtailing that? Or would it make sense to let the state comptroller continue to invest in slavery? I'm not making a parallel with slavery and climate change, but their climate change is the moral challenge of the 21st century, just as slavery was the moral challenge of the 19th century. So number three, the third point she made I thought was interesting was it's hypocritical to drive a car and then ask to divest oil stocks. I would say that has a superficially appealing logic to it, but it's a straw man and false. Because in the world that we live in, for most intents and purposes, it's impossible to disengage from the fossil fuel economy. The iPad I'm talking to you on is made of things from the fossil fuel economy. The infrastructure we have is not yet sufficient for most people to be able to move into electric cars. The technology is not quite there. So we are price takers in the fossil fuel economy. We do not have the power to take ourselves out of the fossil fuel economy and let's go live in Walden in the woods in a cabin somewhere, possibly. But we are not price takers with our investments. Our investments can lead us into the future, and we can invest in the kind of world that we want to live in. And we are price makers in the investment world. We have our own volition, and we have our own free will to invest our dollars as we choose. We do not have to take the world exactly as it comes in terms of the current. We can invest in the kind of world we want to live in. So that's an important point. The fourth point I think that my colleague made was that nobody's doing this. No other states, no other institutions, and there's no other states for certain. And so what I wanted to say on that is there are many large funds, including the Norway, one of the largest sovereign funds in the world, almost $1 trillion US, the Norway Oil Fund, ironically built up wealth from oil. And they have recognized that there are some oil companies that have a high risk of stranded assets, and they have made a strategic decision to divest from those companies. So that's happening with the funds of almost $1 trillion. There's other funds like the Dutch Health Workers Fund. It's a little bit bigger than the New York Common Retirement Fund out of Holland. They made a decision to divest from 250 companies, including many oil companies as well as coal companies. And they're doing that again on the notion that they want to avoid stranded assets because they have pensioners, they have obligations they're going to have to make. And we've seen 10 years of underperformance, and we see the world changing, and they want to get on the train before they lose any more of their investors' monies going forward in the long term. And the fifth one, I think, was quite rich in irony, which was that divesting is at best a symbolic gesture and will not change anything. And I think the mere presence of the API in this debate and the fact that there's a whole website called Divestment Facts, which I would argue are not necessarily facts, but this is that high a priority of an issue for the American Petroleum Institute, I think suggests that it indeed does have more than symbolic power and is dangerous, not necessarily for the cost of capital for firms, but for the symbolic climate that it creates and for the legislative climate it can create in terms of applying to more restrictive legislation for fossil fuels in the economy at large. So now I'm not sure if I had some materials that I'm not sure we're able to make it to you, but I have a presentation I'd be happy to share after. And the first point I'd like to make is, what does divestment mean? What does divestment from fossil fuels mean? So the legislation that's being tabled, the Fossil Fuel Divestment Act, calls for divestment of the carbon underground 200 companies. Those are the largest publicly traded fossil fuel companies. It's defined by carbon content in the company's proven oil, gas, and coal reserves. This is a good start, but please let me be clear. This misses potentially the forest for the trees. It does not address coal-fired utilities, which make up by far the biggest source of carbon emissions in most portfolios. Now, and this might be one stat that my colleague from the API would be more in agreement of. So oil companies, in terms of all the oil companies on the S&P 500, if we look at their weighted carbon emissions, so their carbon emissions scope 1 and 2 over their sales, and we take that as a percent of the overall weighted carbon emissions of the S&P 500, oil companies only represent 6% of the carbon intensity of the S&P 500, whereas coal utilities represent 40%. So coal utilities, the big utilities who generate more than 30% of their power with coal, they are the biggest source of carbon emissions and carbon risk, I would argue, in a portfolio. So I think this act is a great start, but it would be much better if it was also to include coal-fired utilities, which generate more than 30% of their emissions from coal. Coal miners are only 3% of the S&P 500's overall emissions. So mining companies that are mainly comprised of coal, they only represent 3% of the overall carbon intensity of the S&P 500. So coal is 3%, oil is 6%, and coal utilities is 40%. So coal utilities is a huge missing spot of the current legislation that it could help strengthen it. My second point I'd like to make is why not divest? And the main reason why not divest that people usually bring up is it could hurt returns. So we conducted an analysis using a snapshot in time of the New York Common Retirement Fund's holdings as of March 31st, 2012, on the reported holdings. We took the top 100 holdings by value in the equity portfolio, and we ran the numbers to see what would happen if the fund had divested from the coal 100 to oil 100, and also from coal utilities over 30%, and then reinvested that money into companies that we call green blue chips. Those are companies that derive at least 20% of their revenue from climate solutions. So Bloomberg New Energy Finance has classified companies for their revenue by new energy, and an outfit out of UK, FTSE Environmental Markets, has classified companies' revenues by what percent come from environmental markets providing environmental solutions. So using those two databases of the green companies that were already in the portfolio, we took the money out of the fossil fuel companies, we put it into those climate solution providing companies, and then rebalanced it at a quarterly basis over 3 years. And we found that had the New York Common Retirement Fund implemented a strategy similar to this, they would have made an estimated $5.3 billion extra over the past 3 years. $5.3 billion. So the cost of not divesting was estimated $5.3 billion. Now, if this money had been divested and just injected into the general stock market, according to the size of the companies in the holdings of the top 100, the number is roughly the same. So it's 5.3 different decimals. So $5.3 billion if the fund would have divested from fossil fuel companies. This is directionally consistent with market trends for major indices across the world. This data is out there. Over the 5-year period to December 31st, 2015, the global index of the MSCI ACWI ex fossil fuels has outperformed the MSCI ACWI by an annualized 136 basis points, which is quite substantial over a 5-year period. The FTSE Environmental Opportunities 100 Index, which tracks the 100 biggest companies with significant revenue over 20% to environmental solutions, has returned an annualized 5.7% for the 5-year period to December 31st, 2015, while the MSCI World Energy Index of the 100 largest oil, gas, and coal companies has lost an annualized 3.21% over the last 5 years. So if you would have invested in the global index of energy companies, fossil energy companies, each year you would have lost 3.21% on an annualized basis over the last 5 years.
Toby, we're going to actually have to cut you off because it's been, I think, 11 minutes. I apologize, but we have your testimony. So if you could just make a closing sentence without completing reading, I'm sorry.
Sure, no problem.
Thanks.
Okay, so I think just to quickly touch on the point, can you hear me better now? Is it still echoing?
So if you could just close, that would be great.
Okay,
Sorry.
sure. So the New York Common Retirement Fund has shown leadership in many areas on engagement and on creating a small portfolio of low carbon stocks. But to date, only 2.7% of the portfolio has been targeted for sustainable investment solutions. And 2.7% of the portfolio, even though it sounds like a big number, 5 billion, is still 2.7% of the portfolio. Other global investors are doing their entire equities and fixed income targeted for 50% reduction in carbon risk. And given the systemic implications of climate risk, the fund has a fiduciary responsibility to take a view on how climate change will impact the allocation of resources to different kinds of energy assets. By implementing a phased divestment backed up with targeted engagement, which will be much more effective when there's the credibility of actually having divested, companies will listen to you because they know there's a consequence. The fund has a great opportunity to accelerate and get on the right side of the energy transition and the right side of history. Thank you kindly. I'm happy to take any questions that there may be.
Thank you very much.